Hello, everybody, and welcome to the Like a Tortoise channel. Very happy to have you join us. If you are new here, welcome, and if you are not, thank you so much for the ongoing contributions. Speaking of which, I recorded I recorded our first live Q&A session on the 20th, so that was on Saturday, and some of you did manage to join. So I'm very grateful, and I hope you guys managed to get a lot of insights from the call, made the most of it, essentially. So I'm very happy, and this is something that I want to continue to do probably once a month. So let me know in the comments if you would like that idea. But yeah, it's all about sharing value and responding to any of your questions. So I'm very grateful. And today, I want to take the opportunity to actually talk a bit more about something that just stuck with me ever since we had that call. Namely, some of you have asked me to analyze specific businesses, and I noticed a pattern. And so today, I want to delve deeper into that. Okay. So before I do that, let me just share here something that I think you guys will find very insightful. And so this is one of my LinkedIn posts that we that we like a tortoise as a company we like to post information on across social media, but mostly on LinkedIn, where we are most active. And so this is something that relates to what I'm about to discuss now, and it has to do with the company's competitive advantage, or the moat. So let me just quickly read this to you guys, which I think is very telling. The average investor is distracted by flashy headlines and short-term price movements, the hare trap. The tortoises, on the other hand, focus on one thing: the quality of the business itself. So how do you measure quality? We look for a moat. A business moat is a structural feature that allows a company to fend off competition and earn high returns on capital for many years. The key here is for many years. If you don't have a moat, you are investing in a commodity that will eventually be run down to zero profit. So the key to outperformance: data confirms this long-term fundamental focus works. The Morningstar Wide Moat Focus Index has significantly outperformed the S&P 500 index over many years. So at Like a Tortoise, when we look for a moat, we focus on specific financial data. And these are the fundamental metrics that separate a great business from a mediocre one. Namely, you have the high return on invested capital. And so I typically like to aim for companies with ROIs at 10% or above, because it's a critical measure of management's ability to generate profit from the money they invest. Okay, consistent growth. This is actually very important. You want to see a growth consistency across metrics like revenues, earnings per share, free cash flow per share, book value per share, and so on and forth. Okay, and again, for many years is essential. Okay, so in this case, I'm looking for 10-year track records. Time-tested resilience. We focus on well-established companies with proven business models that have stood the test of time. Okay? We are not chasing the next big thing. We are instead investing in well-established castles that consistently print cash. And this alone has allowed us to achieve about a 30% annual growth rate since inception. So why have I walked you through all of this? Because two companies that were mentioned during our Q&A session, so they don't have established business models. Okay, and I discussed this. If you were in the call, then you know exactly how I advocate against investing in companies that still don't have a proven track record. And so, but it's best if I just show you an example. So some of the companies that you guys asked me to analyze were these ones. So number one, we had On right here, On Holding AG. What do? They engage in the development and distribution of sports products such as footwear, apparel, and accessories for high performance running. I would have immediately just exclude this company. I would have given it a hard pass because the company went IPO in 2021. So where is my 10-year track record? You see what I mean? If you don't have a long-term track record, this means the company has not proven itself yet. Okay, you don't have a proven business model. You don't have a long-term track record of revenue, of earnings growth, and then by definition, it's not a company with a moat. It's a speculative investment, and you can do very well, but provided that you really understand the company. But why? My point is, why would you be gambling with your hard-earned money if you can achieve staggering results by focusing on what has already proven, on what has already worked over several years? And so this company here, you don't have a long-term track record, as I mentioned. And in fact, if I go here to the financials, you can see that net income has only turned positive in 2022. So that's it, 2022. What? So no moat in all likelihood, right? So what's the competitive advantage of this company? And if to answer that question, we have to look at the numbers. And if you look at a 10-year track record, and if you see some predictability and consistency in the numbers, that tells you something. But this, I mean, only 2 to 3 years of profitability is not enough, not even close, which means this is a speculative investment, okay? And another one that was mentioned is Pagaya Technologies. And again, right off the bat, you can see that this company is a software business, which is obviously susceptible to disruption from AI. But so that alone should keep you on a hedge, but should have you on edge. But what's more, the business only IPO'd in 2022. So again, if I look and if I go here to the financials, look at that, you can see that they have actually been losing money. Look at the earnings. So this is even riskier than the previous one that I showed you, which is already risky. Yeah, but this one, which is understandable, a company that is new, just getting started. So many of them are actually losing money initially. So this will happen. But the point is this: would you actually put some money to work in money-losing businesses? No, of course not. What's the point, right? I mean, there are no guarantees. It's a probabilities game, and you want to stack the probabilities in your favor. That's what I want to say. So the longer the track record, the better for you. Okay, and so another company that was mentioned was, for example, Broadcom. Broadcom, very good. So here we already have a track record. Oh man, what's the ticker symbol? Broadcom. Yeah, here we go. So if I show you Broadcom right here, if I go down, you can see that the company has been around for many, many years, which means you already have a long track record of numbers, and that's what you want. And so if I go here, for example, to financials, you can see, look at this amazing track record. Look at that. Revenue since 2000, going back to 2016, look at that, at about 20% per year. Predictability, look at the consistency in the numbers, very good. Same thing with earnings, look at that. Okay, so it's a bit more bumpy if I go from 2026, but for example, since 2027, they still have grown earnings by about 40% CAGR, which is staggering. It's a bit bumpy. Let's have a look at free cash flows, by the way. So free cash flows, look at this, much cleaner, right? Less noisy. Since 2017, look at that, 22% compounded annual growth rate. So this is typically what I would like to see. Some consistency and predictability in the numbers over a 10, 15, 20 year over a 20-year period. All right, and so the only problem that I flagged with Broadcom is, of course, the valuation, and especially this is a company that is quietly is been quite often is been very discussed across social media. Okay, and of course, and so it belongs to many investors' portfolios, which explains the high valuation multiple that the business trades at. But so the point that I want to again to emphasize, guys, is that if you really want to minimize your losses while maximize your upside potential, stick with companies with sustainable, stick with companies with already proven business models, seek companies that have at least 10 years of data, okay, so you can make sense of the numbers, and make sure that you have the odds heavily stacked in your favor. And this will allow you to achieve stellar growth rates over stellar results over time without having to speculate, without having to chase the shiny object, which is the reason most investors will always underperform. Okay, so yeah, it was a very educational live Q&A. I really enjoyed it, and I'm always learning as well, because it caused me to, for example, I had to look at companies that I had never paid attention to, and I would have excluded them immediately for the reasons that I just mentioned, right? So they don't meet my criteria for a moat, for quality, but it's always very insightful. So and I want to see more of you guys joining the next call, which will take place sometime next month. Like I said, I mean, I intend to do this more often, like once a month. So if you like the idea, just let me know in the comments below. And again, if you find this video helpful, please share it with your relatives, friends, people that are passionate about the markets and can benefit from what we are doing right here. And yeah, let's stay tuned. Cheers, guys.